Välkomna till Global Games-podden. Jag heter Per Ståhl och med mig vid min sida har jag min kollega Karl Lans. Välkommen.
Tack så mycket, jättekul att vara
här. Jag vill bara först säga att dagens poddavsnitt sponsras av Coeli Frontier Markets. Och Karl, vi slås ju lite av att tillväxtmarknaden har ju haft ett urstarkt år i år. MSCI Emerging Markets Index upp 20% i år. Men jag vet att du har tittat lite på indexet. Det är ju 3 aktier som har gått väldigt bra och förklarar mycket av uppgången.
Ja, det är framförallt SK Hynix och Samsung i Sydkorea och TSMC i Taiwan. Och index är upp ungefär 20%, men de här 3 jättarna då står för ungefär 15% av uppgången. Så det är ju en enorm koncentration kan man säga.
Ja, och det där har ju väckt frågan. Jag har skrivit om det lite att den här diversifieringseffekten har försvunnit nu mellan kanske framförallt om man har amerikanskt index, investering eller en global fond. Men vi ska titta på en marknad nu som är väldigt spännande där man fortfarande kan få en stor diversifieringseffekt. Alltså man kan sprida risken väldigt mycket. Och det är ju, tycker jag, nästa generations tillväxtmarknader, det som vi kallar för Frontier Markets, som inte så många investerare har hittat till överhuvudtaget och där man får väldigt, väldigt bra diversifieringseffekt om man adderar en sån fond till portföljen då. I dagens avsnitt ska vi faktiskt prata med 2 stycken Frontier Markets-förvaltare som letar bolag i länder som Vietnam, Kazakstan, Kenya, Egypten, Rumänien. Gemensamt nämnare att det är ekonomier som växer snabbt. De har bolag som växer väldigt fort också och som är kapitalhungriga. Och sist men inte minst så är det många investerare som inte har hittat dit överhuvudtaget. Med oss idag har vi Hans-Henrik Skov och James Bannan som förvaltar fonden Coeli Frontier Markets. Very welcome, James and Hans-Henrik.
Thank you.
Thank you.
I think first we have, what exactly are frontier markets? I mean, many investors have heard of emerging markets, but what separates frontier market from emerging market?
Yeah, it's a very good question. You know, as you said in your introduction, the emerging markets is dominated by the large northern Asian countries, China, Korea, Taiwan, also Brazil and India, the sort of larger developing market countries. Frontier markets are essentially in an earlier stage of development. So in a lot of ways, they look like emerging markets did 20 years ago. You can see that also in the level of wealth. If you look at a GDP per capita, frontier markets is around $4,000 to $5,000 per capita, while emerging markets is closer to 20,000. So they are less wealthy than traditional emerging markets. And another important distinction, and this is also a little bit to your introduction here, is that there are also the markets globally that have the least foreign participation in terms of investors. And that really makes it an attractive hunting ground for fundamentally based investors like ourselves.
Is that interesting when you're talking to companies? Are they happy that someone is calling them and are interested in the companies when you're calling from Copenhagen, or so to say?
Yeah, of course. I mean, when foreigners like us invest in frontier markets, that's a rubber stamp for the local management team that they're doing something right. So there is definitely some prestige for these local companies that foreigners are looking at them because it's not many that are.
And when we look, visit these countries and meet these companies, they are, as James says, they're really willing to meet with us, and that's probably because we are some of the few foreigners that comes around. But we do have access to the CEOs of these companies, the CFOs of the companies, so it's really high level. And maybe it's easier for us than if we were just running around in emerging market or in US equities, etc. But we do have access to the top level of pretty much all our companies.
Yeah, that must be a big difference. I mean, if you were covering TSMC, you might not even meet the CEO, I think.
Exactly.
And now you can call them. So that must be a good benefit. How is the coverage from sell side? Do you need the local banks or to get research, or how do you develop research?
No, not really. Well, on average, there's like 1 to 2 analysts per company in the frontier markets, where if you look at emerging markets, the average is probably closer to 20. And I know, like now you mentioned TSMC and there's also Samsung and those companies. There's probably more like 50 analysts covering those companies. But there are, one or two, and most of our companies, and some might even have three or four. But what usually this is local analysts, and they can help us sort of on the description of companies. They can also help us with sort of rumors. Is this a good management team? How what do all the stakeholders say? How do they treat all the stakeholders, etc. So they can give us some insights on the management, etc. And some description of the company, but they can't really help us on assessing the company with sort of a long-term horizon. As we see ourselves as business owners, when we invest in a company, we want to own them for the next 10 years. And that's probably a very different mindset than maybe many investors, especially also the local investors, but also the local sort of analyst community in these societies.
And so it also means that these are the least ineffectively priced markets in the world. So it's both this absence of foreign fundamental investors and also a lack of depth on the sell side means that these markets are very inefficient. And that provides a lot of opportunities for active managers like ourselves to find fantastic companies at very active valuations.
Why do you think these markets are so overlooked by international investors?
Well, part of the reason is because frontier markets isn't included in MSCI All Countries World. So a lot of the investors, when they're allocating money, they've got these pockets. You've got the developed world, obviously dominated by the US. You've got emerging markets, which is dominated by some of the countries you talked about before. But frontier markets is not part of MSCI All Countries World. So for that reason alone, it means that a lot of investors simply don't look at it. Also, these markets are the least liquid markets in the world. And that means that some of the big pension funds or the big asset allocators, for them, it's a little bit too difficult to build a meaningful position. But all the while, that means that the opportunity set is extremely attractive for investors who are willing to overlook these things.
That sounds like you have found a pocket in the global financial market. Tell us a little bit about the fund and how you find companies in this interesting space.
Yeah, so now I've been investing in this space for like almost 20 years now, and James more or less the same. The first 5 years of James' career in Frontier Markets was in private equity, where he lived in Vietnam. But then we joined forces in 2011, and we've been traveling all over the world in all these countries for so many years now. So nowadays, we pretty much know all the markets, all the companies there is to know. So it's more like if there's a new IPO, as we saw in Uzbekistan last year, then we will take a look at it and evaluate if that should be something that's in the fund. But in the initial days, I was just traveling around, speaking with the local brokers, etc., that could introduce us to many companies. And then we sort of circled it down to a focus list nowadays around 90 companies that we spend like 90% of our time on, is following these companies and seeing how they develop, etc. And out of those 90 companies that meets our high quality criteria for the business, there should be some competitive edge, etc. The management, that they should really have a strong management and a solid cost of capital understanding. Also, the financial ratios should have been looking good over the years. For those companies that meets our criteria, out of those, we create a portfolio of between 30 to 40 companies, where we basically get the most quality for the buck. So we would be, the turnover would be related more to if the valuation goes up a little bit in one company and it's very cheap in another company, then we might move our investments towards the cheaper company, but it has the same quality, might be in a different country, etc. So we all the time get the most quality for our investments. So that's how we sort of construct our portfolio. Maybe we can just add now, we talked about management and we've done this for many years. Some of these management teams we have met over the last 15 years that we've got to know quite well. And that's also very important, when investing, that, what the CEO or CFO told us 5 years ago about their CapEx plans, about the margins, the prospects, etc. And then we can evaluate them over the next 3, 4, 5 years. And today we can see, okay, well, you said this 5 years ago, but you didn't meet the target. What went wrong? Or you did overspend on your capex. So we have we've known many of the management teams for many years, and that's very important when we see ourselves as business owners.
Country-wise, Vietnam is your largest market. What makes Vietnam particularly attractive, do you think?
Well, Vietnam is, as you said, the biggest country allocation. We think from a top-down point of view, there is a lot to like about Vietnam. It has a very ambitious government who is really focused on generating growth and welfare improvements in the country. It is also benefiting from its proximity to China, no doubt about that. Its place in the supply chain and the global desire to diversify supply chains. It's also, and as a result, we're looking at GDP growth rates of, somewhere between 8 to 10%. What the government is targeting over the next couple of years. So top down, everything looks pretty good in Vietnam. But for us, as bottom up stock pickers, it doesn't really matter if there's not companies that can benefit from these high rates of growth, run by managers that are astute at allocating capital and at companies at very attractive valuations. So at the moment, we really see a combination of that. We see companies that are growing extremely quickly. Last year, our Vietnamese portfolio experienced earnings per share growth in US dollars in excess of 25%. They have, on average, a return on equity of 22%, and is trading under 10 times earnings at the current juncture. So you have this sort of combination of companies that are growing extremely quickly and generating good returns and at attractive valuations. So when you look at the portfolio and the country allocations we have within the portfolio, of course they are in some way influenced by the top down or the macro outlook for the country, but what's much more important is that we are able to find companies that can benefit from that growth.
Banks are quite a large part of your portfolio. It's more than 60% of the fund. What makes banks so attractive in frontier markets?
Yeah, so banks is a very good way to sort of get exposure to economies. So the backbone of the frontier market economies are banks. They are a good proxy on the economies. And these economies, because they're coming from such a low base, to some of the fastest growing countries in the world. On average, our countries are growing around 5% GDP growth per year. So banks is actually a very good way to get access to that growth. And banks tend to grow sort of a multiple on top of the GDP growth. So that's the first thing, that it's a very good way to get exposure to these economies, because banks are the backbone of an economy. But the other thing is also banks is very strong businesses, or tend to be very strong businesses, or high quality nature. Not all banks, but a lot of banks are very high quality. The reason is that, or one of the reasons is that the customers are very loyal. So you walk into the bank, in Kenya and Nigeria and Bangladesh for the first time, and you become a customer of this given bank, then you tend to stick around for a generation or two, maybe even longer. And we can just ask ourselves, how often do you swap banks? Do you change banks? You don't swap banks, the last 10 or 20 years. Some might have done it once, but otherwise most people do not swap around. And the banks, they know this. So that's why they can, charge a little bit higher lending rate. They can charge a little bit lower deposit rate. And that means that the net interest margins are very high. And especially in frontier markets, the net interest margin, which is the difference between the lending rate and the deposit rates, sometimes we even see 10% net interest margins. So if you ask any Swedish banks, they would love to have even just a third of that, half of that, So they don't even get close. So these markets, they get these cheap deposits, where generally, you get a deposit rate that's much lower than the inflation rate. The inflation tend to be quite high in these markets. So basically, depositors are being paid a negative real interest rate. And then, the bank turns around and they just have to be, somewhat conservative on the lending side. And then they actually have a very solid business. And we have looked at these banks for many years. And the banks we have in our portfolio are the ones who are a little bit more conservative and have been very strong through the cycle, the economic cycle. Because we don't invest in the fastest growing bank, because they tend to be the ones that hits the biggest problems, the biggest roadblocks when the economic cycle turns. And we've just seen that over and over again. We see ourselves as business owners. We own these banks through the cycle. Some of these banks, I started looking at in 2009, and are still, invested in some of these banks. So banks, they have a very loyal customer, they have a solid business, and they make some return on equity, which is essential for us. That is quite high, 20 in the 20%, above 30% for some even. So we have some great banks, and it's a fantastic way to get exposure to frontier markets.
What's really important in the banks is that, as long as you're choosing banks that are conservatively run, a high quality bank where they can attract these very cheap deposits, as long as you're selecting the conservatively run banks, you're essentially getting geared exposure to the fastest growing economies in the world. So it's a really attractive place to stand.
What's your favorite banks in the portfolio, and do you have any bank holdings that you have had all the time since the start of the fund?
Yeah, so some of the banks that have that's really been strong is that we've been owners of the two banks in Georgia, Bank of Georgia and TBC Bank. And, those are some of the Bank of Georgia, we basically own since 2009. And what we really like here is we have two banks that is sitting on almost 80% of all banking assets in this country. So not only do they have the loyal customers, but the competition is also very lacking. So those two banks have sort of been, over the years, been able to capture the GDP growth with lending rates of 20-15% per year, and they've kept deposit rates low, so that the funding of the banks have been very attractive. So they've been having, return on equities between 25 and above 30% for more than a decade. And they've been growing very fast at the same time. So they have been some of the very favorite banks that we've been owners of over the years. And people would say, Georgia, why at all Georgia? And this is just a small country there in Central Asia. But there's previously been some fantastic reforms in the 2000s and into the 2010s. So that led to a lot of economic growth. Also, after the Ukraine and Russia war started, there's been a lot of migration of the higher skilled Russians and Ukrainians. They've moved to Georgia. So the last almost 5 years, we've actually seen very high GDP growth, even above 10% as a couple of years in a row. So that's been one of our favorite places. But on the other hand, also 2 years ago, we were able to buy one of the premium banks in Kenya at 1x price earnings. That means the market cap is equal 1 year of earnings. That's also extremely attractive. The economy is not as attractive necessarily, and the structure of the banking sector as Georgia, but when you can get a high quality bank that is have above 20% return on equity and is still growing, and you can buy that at 1x price earnings, that also makes it a favorite, to be honest.
Is banks the key drivers for this year's performance of the fund, or what kind of companies has performed very well this year?
Yeah, well, actually, one of the best performing companies this year, and we can't really generalize with banks as such, because what is driving bank returns in Kenya and what is driving bank returns in Georgia are two totally different things. They're really driven by the local economy and the local markets. So we can't generalize on a sector basis like that. We have some banks that have performed very well. Actually, one of our best performing holdings this year has been a company called Helios Towers, and it's a Pan-African independent mobile tower operator. So essentially, it owns the masts that the mobile operators put their equipment on. It's big in Tanzania, DRC, Oman, amongst many other countries, and it's a really interesting business model because in the markets in which it operates, the demand for data and other mobile equipment is expected to increase by 5x over the next 5 years. And that means that the mobile operators, they will need more equipment on Helios Towers masts. And as it has more equipment on its existing masts, the return profile increases dramatically, and cash flow generation from the individual mast increases significantly. And what we've seen over the last 18 months is a increase in its operational leverage that's really driven free cash flow development and earnings, and stock prices also.
You just said something very interesting. You said a bank in Africa or a bank in Georgia, they have different drivers and it's very separated. Is that one of the key? I think when you look at the standard deviation of the fund, what I'm very surprised is that the standard deviation is very low. It's even lower than emerging markets. Why is that?
Yeah, a lot of people are surprised, right? Because intuitively, frontier markets are riskier than emerging markets, and you would expect more volatility, which is what you're getting at. But actually, the opposite is true, and that's because there's a couple of reasons. But generally speaking, these markets are very much driven by local investors, retail investors, local pension funds. A lot of the time that money is trapped in Vietnam or Nigeria. They don't have a mandate to invest outside of their home country. And because it's local investors that are driving the market, often 90% plus of the average daily traded volume, it is the local market sentiment, the local economics that is driving those stock prices. And if you look at a country like Georgia and a country like Kenya, as I mentioned before, they've got totally different drivers of market sentiment and economic growth. And what it means is that there is absolutely no correlation between the Georgian market and the Kenyan market. In fact, when we look at the correlation between the markets in which we invest in, it is that from a technical point of view, the R squared is 0.1. It means there's almost no correlation between the markets. And what that means is that we could wake up one day and something bad has happened in Kenya. Food prices could have increased. Maybe Tanzania invades Kenya. It's not a base case scenario, but if one of these events that happens on a country basis happens, then the stock price of all of the assets in Kenya will fall. But that will have no impact on our assets in Georgia or in Vietnam or in Pakistan. And so in that way, we're able to diversify some of the single country risk on a portfolio level, and that means that there is lower volatility. Another important factor here is that there are no passive funds that follow the global frontier market space. So MSCI does have an index for frontier markets, but there is no ETF that follows that index, and that means that you don't have the sudden inflow and outflow of money into these markets across the portfolio, and that again reduces your overall volatility.
If you're like a private investor, you have a fund portfolio, so it would be wise to have a piece of frontier markets, obviously, for the diversification effect. How much do you think would be reasonable to have? I know you are part, you're running the frontier market, but what do you think could be like? How much do you think?
we saw some statistical studies some years back where they were looking at the efficient curve and the optimal portfolio, etc., with like various asset classes, on the stock market or equity asset classes. And given that frontier markets has a very low correlation to emerging markets and the developed world, it was actually given a quite high, I think it was around 15% of such of the optimal efficient portfolio was 15%, because emerging market and the developed world, they correlate. If interest rates goes up, emerging market and developed world falls, but frontier markets might stay, like the same. And if Trump introduces tariffs or whatever, emerging markets might fall together with the developed world. But the frontier markets, might be insulated from that. So but that was more. That was sort of a theoretical study of the efficient optimal curve. So that was like 15%, because it does diversify your portfolio, because it's something completely different. But honestly, when I think about it, this should be more like the extra spice of anybody's portfolio, because it's a little bit different. So our thinking is that, and that's also what we tend to communicate, is 5% is probably not a bad number, or up to 5% in a portfolio. It should be the extra spice in your portfolio.
Yeah, but if I might add here as well, of course, these are markets that are less well understood by foreign investors. They are also markets in an early stage of development. But if we look at the cold hard numbers of the portfolio over the last 10 years, our portfolio has generated earnings growth in US dollars of 16% per annum. That means that in 2025, our portfolio of companies was earning 4.5 times what they earned in 2015. So this is real hard currency earnings growth that is hard to ignore. And by way of comparison, if you look at the traditional emerging markets, they've grown by less than 2% per annum. So our portfolio has generated far more growth, even though they're in countries that are less well understood.
Can you have that the same? Do you think about, if you look at the frontier markets in the next 5 years, 5 to 10 years, will it continue the strong EPS growth?
I can't promise 16%. That's extraordinarily high. The developed world over the same period of time, that includes your Nvidias and Teslas, etc. They've only generated 7% growth over the same period of time. I can't promise 16%, but our thinking has always been that our portfolio will generate 10 to 15% US dollar earnings growth through the cycle. And that's the sort of numbers we're looking into. We don't see any reason why that will be different for the next 10 years as it has been for the previous 10 years. And that's simply because we're in very, very early stages of development here. So the growth potential is phenomenal. So at 10 to 15% annualized earnings growth, it means that earnings will double every 5 to 7 years. That's what we can expect for the next 10 years.
And we think it's realistic, because we've made studies of like emerging markets in the 90s and in the 2000s, where emerging market looked similar to where frontier market is today, early states. But also when we look at the companies, and it really boils down also to our investment philosophy of only focusing on high quality businesses, because high quality business, they can generate internal free cash flow that they can utilize to capture the high growth we see in these markets. The GDP growth is, on average 5%, some even higher. In order to capture that growth, because growth is given, it's about how do you finance your investments into, production lines, branches, brands, etc., in the local market. And high quality business, they can finance their own growth. And we sort of, when we put it together, on average, the return on equity weighted average is 37% for our companies. That's plenty enough. If they take half of that earnings and reinvest it at 37% return on equity, they would be able to generate actually slightly above the 15% earnings per share growth. So when we look at our companies, and maybe the return on equity, I don't know if it will compress, but maybe it will. So, a conservative number that we put on our calculation is then that the earnings will grow 10 to 15% per year, because our companies, they can finance themselves such a growth.
How do valuations in frontier markets compare with developed and emerging markets today?
So our fund is trading today at a trailing PE, so that's realized earnings, at 8.4 times PE. And emerging market is trading at 19 times. So our fund is actually trading at a 55% discount to emerging markets. So if you buy $100 of earnings in emerging markets, you're paying more than twice as much for that $100 of earnings than you do in our fund. Developed world, MSCI World, is trading at 24.9. So that's around 25 times earnings. Of course, you have all these tech names, Nvidia, etc. Of course, extraordinarily strong companies with very rapid growth. So, but the market has also recognized the quality of these businesses. But the interesting part is that our fund, it's trading at under half the multiple of emerging markets, but the return on equity is 37% weighted average for our fund versus 13.6% for emerging markets. So we are actually able to create a high quality portfolio, which is evident in the numbers, 37% return on equity. We can create a high quality portfolio much higher than emerging market. And because these markets are so overlooked and inefficient, driven purely by local retail investors, etc., no foreign investors, we can buy this portfolio at 8.4 times trailing PE. So you can get, and usually, in emerging market, you can create a high quality portfolio as well, but you would then be paying 25 or 30 times PE. But in frontier markets, we create a high quality portfolio and you only pay 8.4 times PE.
And just to put it in context, 8.4 times trailing earnings, it's really at the very bottom of the historical trading range since we started the fund back in March 2014. So on an absolute basis, the stocks have almost never been cheaper, while the 55% discount to the larger emerging markets is also, on a relatively basis, the largest the discount has ever been over the last 12 years or so. So you're essentially getting stocks that are the cheapest and at the largest discount that they have ever been at.
This was very, very interesting to listen to you, and especially about the valuations and that you find so many opportunities in this market that are so overlooked by investors, I think. So thank you very much for participating in our podcast.
Thank you very much for reaching out.
Hans-Henrik.
Thank you. Thanks for your interest.
Thank you. Thank you very much.
Vi vill påminna om att allt som diskuteras i denna podcast är gästernas och våra egna åsikter. Ingen del av samtalet ska betraktas som investeringsråd. Gör alltid din egen analys eller rådgör med en kvalificerad finansiell rådgivare innan du tar investeringsbeslut.